done this before, but it might be worth doing it again. This is not a gold bar. Okay, it's a piggy bank, so don't come breaking into my house thinking you're going to steal a gold bar. Okay, I can spit it on my finger. All right, but this is the form that most people recognize, right? Called a London good delivery bar. I don't think is that there's a case for gold to be wiped out. Gold's going back to 2100, this kind of stuff. The central bank demand persists. The math of this terminal phase of the debt-based system persists. And so to me, the bid for physical gold, physical silver persists.
In today's news recap, Wall Street bereft of bears, Main Street firmly bullish as geopolitical risk breaks gold out of post-Trump slump. After enduring a 2-week beatdown following Donald Trump's election victory, gold prices saw a strong rebound this week, posting gains in every trading session and gaining nearly $150 by Friday afternoon. Spot gold kicked off the week trading at $2,563 per ounce, and precious metals traders made their intentions known early on, spiking the yellow metal up $10 in the first hour or so of trading and pushing the price to $2,594 per ounce by 8:15 p.m. Sunday evening. Gold continued to test the $2,600 per ounce resistance level throughout the European session, finally breaking through on Monday morning. From there, it was a series of slow and steady climbs punctuated by sharp spikes, higher as a combination of gold supportive data releases and worrying geopolitical headlines pushed the yellow metal upward. The next level of resistance to be breached was $2,625 per ounce, with spot gold breaking through just after Tuesday morning. After a brief pullback following a top just below $2,640, spot gold once again resumed its steady uptrend, hitting the then weekly high of $2,641.42 shortly after. Midnight brought the only significant pullback of the week, with spot gold falling from $2,638 back down to $2,621. But the yellow metal then resumed its multi-day uptrend, and by the North American market open on Wednesday, it was trading above $2,645 per ounce. Economic data then took a back seat to geopolitical news as the ratcheting up of missile strikes and bellicose rhetoric pushed the price steadily higher, with spot gold hitting a high of $2,673 per ounce shortly after Thursday. It then set a fresh weekly high of $2,690 by 10 p.m. and broke decisively through the $2,700 per ounce resistance level around 4:30 a.m. EST Friday morning. Now, before we dive back into the best clips, I've got a deal you cannot afford to ignore. Black Friday's here, and so is your chance to lock in ultimate online security with NordVPN. Listen up. This is especially for you stackers out there. Keep your data safe, stay anonymous, and grab this exclusive offer: 3 extra months free plus a 30-day money-back guarantee. Check the link in the pinned comment. Don't miss out.
The algorithmically programmed trading machines that make up the majority of the volume this time of day usually prompts them to buy gold futures and not sell. And then, of course, the dollar index sees that, or traders or machines or whatever that see those lower interest rates, they sell the dollar. And so the dollar index at one point today was down almost a full point. You put that together, you might expect gold to be up $30 or $40. But it's the other way around. Now, yeah, okay, is there a safe haven bid that's coming out? I mean, how much of gold's rally, even just last week, was due to Hezbollah and Iran? Not buying that one. And I sure don't think the situation in Ukraine has gotten any less scary. And so, I don't know, by deduction, I settle upon just the old bugaboo, which is COMEX option expiration day. This one in November for the December contracts is the one time all year that the front month is both gold and silver, December gold, December silver, and options on those contracts expired at the Monday COMEX close here on the 25th. Those contracts then go off the board and into delivery on Friday, which means you get these massive rolls of positions and spreads that are legged out and taken off and moved from December into February or December into March, as it is for silver. And it just makes it very easy to see price move in ways that are unexpected. It is what it is. I've been covering this stuff for 14 years. And I think even on my site today, people are like, I don't understand. Why do we put up with this stuff? Put up with this stuff because, again, this stuff is an inefficiency. It's illogical. Over time, however, gold has done a fantastic job of protecting you against the onslaught of currency devaluation, and it will continue to do just that. This other stuff, while maddening and frustrating, a lot of time is just noise. The U.S. ran a surplus. Okay, nothing but deficit spending since. That 2002 fiscal year began on October 1 of 2001. The gold price, $290. Gold price today, $2,700. That's a 9x increase. You can also look at it and say your purchasing power, as measured by gold, has fallen by 9x. So, unless you think all of a sudden this is going to change, and it can't, the government cannot, they would absolutely destroy liquidity if they tried to run a surplus again. It would be it's not going to happen. 100% promise everyone listening. Any politician says, yes, we need to balance the budget. They're either don't know how it works or they're just full of crap trying to buy votes. This will continue. Okay? I don't know if we'll go 9x again for another 23 years, but, do the math. Even in this environment where the banks manage the price and their risk and hedging this and options that and gamma this and delta hedge that, whatever. Even in this environment, gold price up 9 times over the last 23 years while this has gotten out of control. So what is it? Another 9 times in the next 23 years. Elijah, what's that? 27,000? That protects you. That's your hedge. That's why, again, if your advisor hasn't suggested you get some, I think you should find a new advisor. Just take it upon yourself and get some.
In today's news recap, a sharp fall in the price of silver has created a buying opportunity for investors following a metal which has better fundamental appeal than its richer sister, gold. The fall of 12.1% over the past 4 weeks by silver is double a 6.3% drop in the price of gold. Both precious metals have been sold off after reports of a ceasefire in Lebanon and the choice of investment professional Scott Bessent as U.S. Treasury Secretary. Gold and silver are classic counter-cyclical investments, rising in times of economic and political instability and falling in stable conditions. But the latest moves have seen silver treated more harshly than gold, with its fall from $34.45 an ounce at the end of October to $30.29, easily outstripping gold's decline from $2,786 to $2,611. A bounce back by silver to around 33 seems likely, with that price tipped by Morgan Stanley, an investment bank, as the target for the second quarter of next year. Strong industrial demand, especially from the electronics sector, is the factor likely to see silver outperform gold next year. Don't forget about silver's PV boom. Whereas only 10% of gold is consumed by industry, an estimated 55% of silver goes into products such as solar panels and photovoltaics, where demand grew by 33% last year and 64% this year. Adding to the appeal of silver is a big market deficit, which started to open 5 years ago and has got steadily wider with the shortfall in fresh mine supply being met by a drawdown in above ground stocks. Now, we'll show you the best clips of the latest interview, but first, smash the subscribe button and check our pinned comment for a massive Black Friday deal. This is your chance to lock in ultimate online security with NordVPN. This is especially for you stackers out there browsing for precious metals info and making sizable investments. Keep your data safe, stay anonymous, and grab this exclusive offer, 3 extra months free, plus a 30-day money-back guarantee. Don't miss out.
They're thinking tax rates might be cut, or tax cuts might become permanent. There might be more tax cuts to come, which could widen profit margins. There's also some actual fundamental anticipation going on there. I think there's a fundamental anticipation going on in Bitcoin too. Trump has talked about a national Bitcoin reserve, whatever that is, or at least, not putting up all the barriers that the Biden White House has done and that Gensler has done at the SEC. And if the U.S. does start buying Bitcoin, I don't know if they will, but he's talked about it. It may have just been a ploy to grab votes. I don't know. But if they do, other countries are going to be forced to do the same. And again, maybe there's a finite supply. We got Bitcoin futures now and stuff like this, but there's still a reasonably finite amount of Bitcoin out there. So, the fact that Bitcoin would go from 70,000 to 100,000 in the last 3 weeks, that makes sense too. There's a case for that. What I don't think is that there's a case for gold to be wiped out. Gold's going back to 2,100, this kind of stuff. The central bank demand persists. The math of this terminal phase of the debt-based system persists. And so to me, the bid for physical gold, physical silver persists. I've done this before, but it might be worth doing it again. This is not a gold bar. Okay, it's a piggy bank. So don't come breaking into my house thinking you're going to steal a gold bar. Okay, I can spit it on my finger. All right. But this is the form that most people recognize, right? Called a London good delivery bar, typically 400 ounces of gold. Okay. So let's say this was a bar sitting in Fort Knox. I joke. 400 ounce bar. When Nixon suspended the convertibility of dollars into gold, closed the gold window, however you want to put it, price $42. Okay, this was about $14,000, $16,000. That's what this cost you. Okay, you need $16,000 bills to buy one of these. Fast forward 25 years. Now we're into the late 90s. At that point, it takes a little over 100,000 US dollars to buy one of these. Same bar. Okay. Fast forward to today. Elijah, what's 2,700 per ounce times 400? Brother, that's 1.1 million. So we've gone from when Nixon cut loose the dollar, about $11,000, $12,000 would buy you one of these babies. Now it's 1.1 million. Has this changed? Elijah, is there like a hedonic adjustment that the Bureau of Labor Statistics could say this is a much more efficient gold bar? No, it's the same freaking thing, right? It just now takes $1.1 million to buy one. Okay? The gold hasn't changed. Your purchasing power has changed. Which is why you can't buy, unless you got $1 million, you're not going to buy one of these babies, but you can certainly buy coal, rounds, little grams, whatever you want. Get some. Forget about this COMEX option, whatever. It's $100 cheaper than it was Friday. Hey, you save some money. That's the best way to look at it, okay? Own physical precious metal. It's your only protection against this madness that, regardless of what you think about whoever won the election politically, the madness is going to continue. It has to. Otherwise, the whole system will collapse under its own weight.
What do you think of Craig's take on the future of gold and silver? Are his predictions aligned with your outlook? Post your thoughts in the comments below. Let's spark a great conversation about where these markets are heading. Thanks for watching, and check this video right here because it's a perfect fit for you. I'll see you on the other side.